You are watching Market Wrap, What the Numbers Mean to You. Keith Springer discusses the markets, the economy, and answers your questions. This week's question, is the recovery sustainable?
Is the recovery sustainable? It's the question I get almost every single day from individual investors. They just don't believe it. High unemployment, soaring budget deficits, continued debacles such as Goldman Sachs that saps investor confidence, and because of this, they've largely been out of the market since the beginning of the rally and don't believe it and react emotionally. On the other side of the spectrum, you've got institutional investors. They have the ability to remove emotion from investing, and they've been bullish for months and have been largely rewarded. They feel the economy is going to get better, and they're starting to be vindicated. You can see the numbers in the economy, the economic releases, start to really improve and show true sustainable recovery in the economy, at least in the short term. Let's take a look at this chart. The best source is the leading chart of economic indicators. With this index, you can see we had a 1.4% increase in March, which brought it to a 26-year high. That's huge. In addition, this morning, General Motors came out and said they had a 20-year high for auto sales, and we have continued manufacturing and production numbers and indicators that have been gaining strength, showing that the economy is improving, at least in the short term. And the institutional traders are being vindicated because of these numbers, and we're starting to see that improvement in the economy is very, very real. Now, we go back to the basic question. Is the recovery sustainable? Well, again, it's a short and a long-term question. Right now, the market has exactly what it needs to keep moving. It has liquidity, it's got low interest rates, and negative investor sentiment, or pessimism among investors. Liquidity with trillions of dollars on the sideline in money markets, on top of which trillions of dollars in bond funds, because those people were afraid to go into the stock market, that will come rushing into the stock market at some point. Low interest rates. The Fed's already said they're going to keep rates low at least through the end of the year. So we know we've got months and maybe a year or two of low interest rates. And third, negative investor sentiment. Believe it or not, the market needs and loves the individual investor to be negative. The theory goes that if individual investors, a large amount of investors are in the market, they're already in and they cannot fuel another rise up. And if they're negative or pessimistic, then they've got a lot of money on the sidelines to go back into the market and push it higher. I've always said when the individual investor gets back in this market, I want to get out. So you've got to be careful there. In fact, let's take a quick look at the chart of investor sentiment. You can see that even after a year plus of a bull market, the numbers just don't add up. Institutional traders stay positive, but the individual investor is decidedly negative. As you can see from this chart, over 50% of individual investors continue to be negative. Not until that number gets over 50% is a cause for concern, and you might want to start looking. But at 38%, it continues not to be anywhere near too high a number for this market to continue. So back again, is the question of, is the recovery sustainable? Well, in the short term, absolutely. It has all the necessary ingredients that we just talked about. However, long term, I have my doubts. There are serious headwinds. The demographic situation of the aging population, they're going to spend less and save more. It's going to drastically hurt this economy. Debt levels of the individual investor are drastically high. In fact, the over-leveraged situation is very, very serious, not only in our country, but in the developed world throughout. Every place. You're seeing problems in Greece, you're seeing problems in Spain, Portugal, the UK will have problems. The emerging markets don't have the same problems, but we can see that we've got some serious, serious headwinds. The government right now is fighting it by spending money that the consumer is not, but we need consumer spending to get back in the game, back to levels to where it was, to make this recovery sustainable for the long term. So as you can see, for the short term, things look pretty good. And maybe, certainly weeks, maybe months, maybe a year at the best, but not for years to come because of the demographic situation and because of the over-leveraged situation. Because you've got to admit, the way to solve someone with too much debt is not with more debt. So you've got to start deleveraging. And the two keys to this is consumer spending and unemployment. If you start to have consumers spend, there'll be more demand for goods and services. That will bring back people off the unemployment line. And that is what's so critical that we have to watch, because the releases coming up in the next several weeks are going to be critical here. This is the point where things are going to start to make a difference. Unemployment has to start going down. If we don't start seeing gains in employment really in the next couple of weeks, you're going to see this market start to question whether this recovery is sustainable. In addition, consumer spending. I cannot believe that consumer spending can get anywhere near where it was before the recovery started or before the debt problem started. Because of the aging population, the demographics of the nation, they spend less and demand more. However, I want to have an open mind. I want to do what I have been promoting for a long, long time now, as you know from my newsletters. Invest with your head, not with your heart. I'm going to keep an open mind. I'm pessimistic for the long term. I'm positive for the short term. But I want to keep an open mind. If unemployment starts to go down and consumer spending picks up, we're going to see positive things happen, not only in the economy, but in the market. So we've got to be open-minded going long term. We've got to remove the emotion from investing and invest with your head, not with your heart. That's what we need to do. So going forward with your portfolio, invest with your head, not with your heart, and be sure you build your portfolio based on what you need, not on what you greed. Thanks for listening.
Do you have questions for Keith? If so, feel free to email him at keith@keithspringer.com.